All right. Good afternoon, everyone. Welcome to the Ceres webinar on corporate boards and sustainability. My name is Veena Ramani, and I work in the corporate programs at Ceres. And over the next hour, I plan to lead you through a conversation that builds on a report that we released in October called View from the Top: How Corporate Boards Can Engage on Sustainability Performance. I'll plan to give you a sense of what precipitated the report, give you a sense of key report findings, but our plan is to spend most of our time on a panel discussion that explores some of the key themes from our work. All right, so this slide gives you a quick sense of logistics. I've already talked about the report overview and the panel discussion, but I hope to spend at least 15 to 20 minutes towards the end of the webinar on Q&A with all of you. The idea is to be as dynamic as the webinar format will allow. So please do keep your thoughts and questions coming through the hour. You can share your thoughts in a couple of ways. You can send me your thoughts or your questions or your comments using the chat function, which is on the bottom left-hand side section of your screen. And what I'll try to do is, as your questions come in, is to weave it into our panel discussion as far as possible. And once we actually get to Q&A, we'll try to read out some of the questions that have come in. And if you want to press the raise hand button, which is, I think, on the top of your screens, it's an opportunity for us to call on people directly as well. As those of you who've been on the webinar from the beginning have likely realized, this webinar is being recorded. So if you want to listen to what I'm sure will be a fantastic discussion again, or if you want to share this discussion with your colleagues, a recording of this webinar will be posted online on the link that's on this page. And this page is also where you will be, in fact, able to view and download the report that we're going to be talking about. Okay, so let's begin with some context, a lot of which I know is quite well known to many of you on this call. So the era of sustainability being a choice between doing well and doing good, I think is over, right? It's increasingly well understood that issues like climate change, like water scarcity, like human rights, real business risks and opportunity and affect corporate value. And this connection between sustainability and value has really been reinforced by a bevy of reports that have come out over the past couple of years that have sort of made the point that companies that perform well on sustainability issues also tend to outperform their peers on a variety of financial metrics, things like share price, cost of capital, etc. Now, investors are starting to make this connection between sustainability and corporate value. And as investors are starting to dig in more and more on corporate sustainability performance, they're also starting to pay attention to the governance of corporate sustainability performance. In other words, what are the systems and policies that companies have in place to manage for sustainability? Corporate boards are becoming very important in this context for a couple of reasons. One, they act as fiduciaries to investors. And two, they are supposed to be stewards for long-term corporate value. Given this, more and more investors are starting to raise material sustainability issues in their conversations, not only with management, but also corporate boards. And as the bar chart on the right of your screen will show, there has been a jump in the number of shareholder resolutions focused on the role of corporate boards for sustainability. Now, Ceres sits at the intersection of companies, investors, and the advocacy community. And as our base has started to get more and more interested in boards and sustainability, we've started to pay a lot more attention to this topic as well. As many of you know, over the past few years, Ceres has been doing and releasing regular assessments of large U.S. companies, focusing in on their sustainability systems and sustainability performance. So we dug into the data just to get a sense of how has this field evolved, and importantly, what impact has this field had. So we found good news and less good news. So the good news is that the number of U.S. companies that are starting to oversee sustainability at the board level has started to increase. It's grown from 28% in 2012 to 32% in 2014. So it's a slow increase, but it's an appreciable increase, especially if you keep in mind that we are talking about making a difference at the corporate board level here. The less good news surfaced when we dug into the data just a little bit more, and tried to see if the companies with the systems that we were looking for also had the performance impacts that we were looking to see. In other words, did a company with a board sustainability committee also have robust greenhouse gas reduction targets or efficient water management strategies or strong human rights due diligence systems? And here, unfortunately, we found that except for a few leading companies, the correlations that we were looking to see was simply not there. In other words, what we found was a gap between intention and implementation. And this made us realize that we needed to start to shift our questions on this issue, right? So the question that we should ask was not, does a company's board oversee sustainability? We realized that the question that we should likely be asking is, what does effective board sustainability oversight look like? And the question of effective board sustainability oversight is really what we spent the past year focused on. And the report that we're talking about, the view from the top, is the results of our work. The report's been informed by detailed literature surveys. It's been informed by the assessments that I just talked about of large U.S. companies. But importantly, it was informed by over 36 interviews that we did with corporate board members, with senior executives, with investors, and with governance experts. We were quite clear that this was a nuanced and difficult field, and we really wanted our recommendations to be rooted in reality. The paper includes both actionable recommendations and leading practices on how companies can create a board oversight system that is effective. I have to say we're especially proud of the leading practices that the report includes. As many of you may know, companies do not typically provide a whole lot of information on the roles and the decisions that corporate boards play on any issue, let alone sustainability. And it was, in fact, our interviews that identified many of the examples that we've highlighted throughout our report. In fact, our report makes a plea for more disclosure, not a surprise for those of you who are familiar with Ceres over all these years. The recommendations that we've provided have been divided into recommendations on systems that organizations can put in place, as well as action that board members can take to integrate sustainability into their roles and responsibilities. The report, in fact, makes the case that it is this combination of systems and action that will lead to the impact that we're looking to see. So over the next couple of slides, I'll slide through some of the specific report recommendations that we put out in our report. But before I do that, I think there are a few underlying themes that are worth underlining. So one is the issue of materiality, right? So we do not believe that corporate boards, and our report does not make the case that corporate boards should oversee every sustainability issue under the sun. But we believe that where an environmental or social issue has the potential to affect corporate value in a material way, it belongs on the board agenda. The second theme is that of integration. So we believe that irrespective of where sustainability is housed, we think that board deliberations on sustainability needs to be integrated with the overarching board discussions on strategy, risk, and revenue, sort of building on our previous point on materiality. And our recommendations, in fact, include ideas on how to make that happen. And the third theme, and this is one that you'll see throughout our report, and I suspect that we'll touch on a good bit in our conversation today as well, is that of long-termism. The one question that we kept coming back to time and time again during our interviews and in the writing of our report was, what is the role of corporate boards to drive long-term planning and long-term thinking within companies? Again, our report includes some recommendations, but this is a large and difficult topic, and we're going to get our panelists to weigh in on this as well. So this slide gives you a sense of some of the systems that we recommend that our companies consider. I'm not going to go through this in a huge amount of detail because I do want to get to our panel discussion. But as you can see, the recommendations cover the gamut from things like how to make sustainability a board priority. Again, this is all about leveraging materiality. It talks about how one can actually create what we call a home for sustainability on a board committee, either by establishing a standalone board committee or through charter incorporation of some kind. We talk about the importance of informed sustainability oversight. And again, this is something that our panelists will touch on again, because in addition to creating a system, you actually want to create an environment where board members can consider issues in a thoughtful manner. And we have a number of strategies and ideas on that. And finally, the systems recommendations talk about the importance of boards and management needing to coordinate with their approaches both on sustainability as well as on business performance. This slide talks about our recommendations on actions that board members can take for effective board sustainability oversight. As you can see, this covers the range from ideas on how board members can integrate sustainability into their role on strategy oversight, into their roles on risk oversight, and clearly making the linkage between sustainability and compensation is a clear role that particularly the compensation committee can play. And as you can see, our final recommendation focuses on the importance on disclosing what the board is or is not doing, both in terms of prioritizing sustainability as well as providing decisions that provide robust oversight of this issue. All right. So let's finally move on to our panel discussion now that we've provided the overview. I want to take a brief moment to introduce our panelists and thank them both for clearly participating on this webinar, but also participating in the project that led to the webinar. Our panelists include Heather Zyko, who's the former Deputy Assistant to the President for Energy and Climate Change and the current board member of Cheniere Energy. We have Mary O'Malley, who is the Vice President for Corporate Governance at Prudential Financial and who works very closely with its Chief Governance Officer, Peggy Foran. And finally, last but not the least, we have Candace Hewitt, who is a Corporate Governance and Social Responsibility Analyst at TIAA. Thank you very much for participating, guys.
Thank you for having me.
Thank you.
It's a pleasure.
Wonderful. So let's begin with the question of why more companies aren't in fact getting sustainability on the board agenda in a significant enough manner. So there are a couple of data points on the slide. One we've already talked about, the Ceres Gaining Ground report, which sort of makes the point that, you know, corporate board sustainability oversight systems in large U.S. companies have grown from 28 to 32% between 2012 and 2014. But this is it's not the majority of large U.S. companies. It's a relatively small percentage. And this I'd love to see juxtaposed with the last survey done by the Boston Consulting Group and Sloan on sustainability, where they surveyed over 2,500 global executives and managers on sustainability. There are a couple of things that stood out to me. The survey says that 86% of the executives surveyed believe that boards should play a strong role in driving sustainability, but only 42% see that their board is even moderately engaged on the sustainability agenda. So there's clearly been, as I said before, a little bit of a gap between intention and implementation. So why isn't sustainability percolating onto the agenda of the corporate board in a significant enough manner? And, you know, given who we are, what can we do to change this? So Heather, let's begin with you. What are your thoughts on this sort of Sloan BCG study survey results that we've noted here? You know, given your vantage point as a director on a corporate board, you know, do you see issues like climate change, water, and human rights, in fact, making their way onto corporate board member agendas in a significant enough manner?
Well, again, thank you for the opportunity to join you. I guess, you know, look, from my vantage point, I would say that the Sloan BCG survey is spot on. And you know, I think the question we have to ask ourselves is, you know, what's the challenge? Why aren't we, as directors, doing more to prioritize sustainability? I mean, arguably, I'm somebody who is the president's top advisor in energy and climate policy and have worked on sustainability issues my entire professional career. But I can also tell you at Cheniere, it is, you know, certainly not something that I think has been properly prioritized. And, you know, I think there are probably a number of reasons for that. I mean, first is competition for time, right? We, you know, as a board, we meet 4 times a year, and in that time we're jamming in everything from, you know, discussions about succession planning, you know, what regulatory hurdles are we faced with, you know, what do our quarterly earnings targets look like, et cetera. So I think that's one challenge. The second I would say is that sustainability is huge. I mean, even the question that you asked, you encompass human rights, water, and greenhouse gas emissions. So sustainability as a whole is a pretty big and complicated monster, which can be really tough for boards to break down. And then I guess I'd say the third piece is that starting something new as part of a board that's been around in many instances for decades, trying to identify that starting point can be a real challenge, and it's tough to, I think, even for somebody who's dedicated to the issue to figure out where the right starting place is.
That's really helpful, Heather. So, one way that companies are, I think, trying to address this issue is by sort of going beyond the person who sort of cares about sustainability and actually creating formal systems for sustainability at the board level, right? Things like having a dedicated board committee or essentially incorporating sustainability into the charter of an existing committee. So will having these sort of formal structures at the board level incentivize the board to pay more attention to this issue on an ongoing basis?
Absolutely. I think formal processes are key, not only to make sure that it is an issue that doesn't fall to the wayside, but that you are able to hold your fellow directors accountable to these issues and raise them as a priority for the board overall.
Great. So, Mary, let me move on to you. So Prudential Financial, in fact, has a dedicated board sustainability committee. Can you tell us a little bit about your journey? How did Prudential, in fact, get to how did sustainability get to the Prudential Financial Board in a way that's sort of significant in this manner, and what was the journey that you went through in fact, creating this dedicated board committee for sustainability?
Well, Veena, I think it would be helpful for the folks on the line to know that I am lodged within the governance area and do have governance responsibilities, but I'm also global lead for sustainability at Prudential. So the first lesson that we learned in our journey, where we have this formal board committee and where we look for board members with skills and experiences in this, is before we even got there was the creation of partnership between governance and sustainability. Peggy Ferran, whom most people in the governance world have heard of, is our Chief Governance Officer, has a lot of foresight, but also believes in proactive engagement with stakeholders. She could see what was coming over the horizon. Prudential is a global company, so we were looking not just within the United States, but also within Europe and South Africa and Asia and elsewhere. So she could see this coming in over the horizon. And she then, we connected with each other because I had governance responsibilities in a previous area, and we were able to sort of figure out what are the ways that we could make these connections, formal connections between our governance structure and between the work I was doing in sustainability. Some of the lessons that we learned, though, was that when you're looking to take that first step, language is very important. And so talking about sustainability, sustainability, as Heather said, can be very daunting. So what is important is to connect sustainability at a more basic level to the kinds of issues that the board would consider on a long-term basis. What are those material issues? Whether they be risks or opportunities, there needs to be a more direct and concrete way of talking about these things with board members. There also needs to be a sense of what is the value add of sustainability, whether it's better risk management or it's helping create a sense of the legitimacy of the organization and supporting the corporation's license to operate, both within the United States but also in the broader world where sustainability is a big fat hairy deal like Europe and South Africa and parts of Asia. So I think the big lessons we learned were that and patience. It's not something that happens overnight. As Heather said, boards have an awful lot on their plate. They're not dedicating every minute of their time to thinking about Prudential or Cheniere or TIAA CREF. So looking for those inflection points where you see an issue that they would normally consider and informing them about what are the long-term implications of that issue can also be helpful in sort of gaining entree and building greater credibility for a formal sustainability function and accountability within the organization.
And Amin, to your point on patience, Mary, I think it's a good lesson for those of us not only in the sustainability space, but I think anything to do with the board, patience is certainly a virtue to embrace. Okay, that's really helpful. So Candace, I'm going to maybe try to get your thinking on this, right? From the investor point of view, as people who sort of talk to company management and company boards, I'd love to actually get your take on this issue from a slightly different perspective. When we wrote this report, we sort of struggled a lot with the issue of the governance line, right? So what is the role of the board vis-a-vis management in driving sustainability within the enterprise? What's your perspective on this?
Sure. So TIAA-CREF, as most folks know, is really a long-term investor, and we're covering about $840 billion assets under management for our beneficiaries. And we really do expect boards to be our representative in keeping an oversight layer and their eye on the long term of the company. So we definitely incorporate sustainability in that thinking, and we look to the board to really make sure that management has a strategy in place, that there are risks associated with sustainability that are being covered regularly. But in general, the board itself is that oversight and governance body, and they're the line into shareholders. So TIAA-CREF really looks to engagement as the opportunity for boards to speak to investors about their position, their understanding of the strategy, and how they are covering those risks and opportunities over the long term. We really feel that there's an opportunity that's been bubbling up over the years for boards to start to come to the forefront on these issues and really be engaged more directly with long-term shareholders and institutional shareholders such as TIAA-CREF. We've seen over the years that usually there is a layer of management representation when it comes to the table between shareholders and boards of directors, so in those engagements. And what we've sometimes seen is that when we raise the questions around sustainability, if there isn't someone already at the table who can speak to that issue, usually the next person that comes to the table is the sustainability officer from the management perspective. And we don't often get the chance to speak directly to boards on these issues. But I do think that from an investor perspective, we want to kind of move the conversation forward in direct engagement with those directors to understand how they are actually overseeing and engaging with management. It really is to, as I think a gentleman, one of the directors at Vince Warehouse shared, the board being the keeper of the long-term vision and values of the company. And so we feel that, they should really be able to be conversant on some of these issues. And we certainly understand that, the agenda is full, and that the conversation needs to start at really comprehensible levels in terms of how we're defining materiality issues. And I think that is also an area of opportunity for the board to communicate out to shareholders how they perceive of the material issues, what are those top priorities and risks that they're grappling with that are specific to their business, and should be willing and ready to kind of communicate that to shareholders through the right forums, right, through the proxy statement and other forms of disclosure.
And as so much of our work does, it all comes down to materiality, the point that you were making towards the end, Candace. Heather made the point in sort of her, when she sort of answered her question about how sustainability was so large, right, how even my question sort of covered off climate change, water scarcity, human rights. So what's your perspective on the role that sort of materiality plays in this conversation that investors are having with corporate boards?
Sure. Well, that materiality is huge. It's really the anchor point from our perspective as investors, right? Because we want to encourage companies to share the information that our analysts are going to consume in terms of understanding the functions of the company, the strategy, and its performance over the long term. And so when we say material, we want to understand how a particular issue in sustainability links back to the company's strategy and its ability to perform. whether that is dealing with reputational risk potential or license to operate. We feel that there's a wide universe of sustainability issues, but for our analysts in particular, we feel it's the board's duty to speak to those issues that have the largest potential impact on the company's performance.
Great, thank you. So let's move on to the next topic, which is that of informed oversight. So we tried to create a little bit of a flow here in the themes that we pulled together. And once you formalize sustainability at the board agenda, potentially using materiality as an anchor and creating the kind of formal systems, either a separate board committee or, as I mentioned before, incorporation into existing committees, I think the next question becomes about informed oversight. In other words, what can you do to ensure that the board's oversight on the environmental and social issues in question is actually knowledgeable and leads to the kind of thoughtful decision making on these issues that we're really looking to create? Now, one way that companies try to enhance their expertise on any issue is by onboarding experts on the issues that they consider to be priorities. However, we really haven't seen that as much as we would like to see on the issue of sustainability. Folks like Heather tend to be the exception rather than the rule. So in doing our assessment, Ceres actually did a little bit of analysis of the makeup of board sustainability committees in large U.S. companies, and we found that only 19% of the directors who sit on these committees actually have discernible expertise in environmental, social, or governance issues. And what we looked at is either their bios on the corporate website or the disclosures provided by the companies in their proxies. So this we found to be really interesting. And Candace, I'd love to actually go back to you. I know that especially over the past years, investors have been all over the issue of board composition, right? So there's been clearly a lot of leadership that we've seen from especially the SRI community around the issue of board diversity in the U.S. And now with the proxy access movement and the growing focus that we're starting to see on the part of pension funds on the notion of climate competent boards, it's definitively, I think, all over, especially our attention right now. So what's your perspective? Does it make sense for a company to actually onboard a sustainability expert?
Sure. Well, I want to kind of come back to this issue around materiality and start there again, because I think one thing to keep in mind when we're thinking about the role of the board and whether there should be one expert versus a broader kind of framework of knowledge is this issue around risk, right? Materiality issues often link to what are the risks that the firm is facing, and really that is where the board's purview is strongest. And so when you think about what are the multiple different arrays that sustainability can impact risk in a company, that's where we think it benefits the board to have a broad perspective on sustainability and conversant understanding with the material risk issues that the company is facing, which will ultimately include sustainability. And so we would shy against, let's say a company being solely focused on finding that one sustainability expert, right? Or even we would shy against investors pushing for companies to advance just one particular sustainability expert. What we think is that the board's role as risk oversight, it really requires that there be a span, a comprehensive kind of baseline understanding. So it's great to have that expert in the room. It's absolutely necessary. But also with that, you need the process for disseminating the knowledge across the board. And that may mean that really the process of deliberation is embedded into other functions, broader functions, whether that's the audit and risk committee or the governance committee's deliberations, so that you have a group coming together to really grapple with the issue, and it's not just a lone voice. So we do think that that's incredibly important. And I would also add that investors really don't currently have a common definition for what a climate competent board director would look like. And so while there's lots of conversation around this and lots of interest in ensuring that the board has that competency, there isn't a consensus on what that truly looks like. And so as investors, we may need to get our ducks in a row so that when we have these conversations with companies, we have a clear sense of what we're looking for, and that companies are not getting such a wide range of different messages either.
Great. Thank you, Candace. So let me maybe pass this on to Heather as well. So Heather, again, as potentially a climate change expert sitting on an energy company board, does the issue of having an expert at the board level matter, right? So, do you think more companies should be doing more of this?
Well, I'm given my background and my position, I might be slightly biased, but absolutely, I think it matters. But I also want to pick up some of the key themes from Mary's response, because I think that those are very crucial points. First and foremost, you can't have one lone voice on the board and expect them to check a box on your corporate sustainability functions. The second piece is, having the expertise is one thing, but if there isn't a formal process or role that sustainability plays in the broader functions of the board and mission of the company, you're kind of just you're just a sort of figure, and you're not necessarily moving the agenda forward. And then lastly, I think Mary's point about we talk a lot in these circles about a climate competent board, but the fact that there isn't a common definition of what that skill set looks like, I think is really an impediment. I mean, as somebody who's recently gone through the process of trying to bring a new board member onto our board, you spend a lot of time thinking about what is that skill set you need to round out, your board of 11 or 15 or 9 members or whatever it might be. But, elevating that as a priority is a good thing. But I think the more we can do to define that and help boards that are in the process of bringing on new directors or thinking about, what skill sets are missing, the better and more effective we will all be at making sure that we are achieving these objectives, and that we are fixing this challenge that we currently face today, with only 19% of the directors that are serving on boards having sustainability expertise.
Great. And building on that point, Heather, I think you made the point, and I think this was reinforced by Candace as well, that it's important for the person with material sustainability issue competence on a board not to be a lone voice, right? So at least from your perspective, what more do you think that companies can do to level up the understanding of the board overall on sustainability issues of material relevance to the company?
I think it's a complicated question, but first and foremost, it really is about going through that process to identify and use materiality as an anchor, so you can match the skill sets you need, bring in the right person, and allow that individual to be successful right out the bat. You have to think about what is the core mission of the company, and what kind of individual are you going to need in order to address those material issues that link back to the company's vision.
That's really helpful. Thank you. So Mary, let me toss this to you now. Prudential is one of the few companies to, in fact, specifically identify expertise in sustainability as something that you've identified as a priority in your board skills matrix. So why did you take the step?
Well, I'm actually here chuckling a little bit to myself, because at my last meeting with the committee of the board that I report to, we had actually very informed discussion about Scope 3 reporting. So the reason that we did this is because Prudential is a life insurance company, and we're not thinking, yes, we are thinking on a day-to-day basis about the interests of our shareholders and how do we, create the appropriate return for them. But also we have what called long lead liabilities, meaning that if you buy an insurance policy from us today, we may be paying that benefit 50 years from now. We have pledged for many people to provide them a consistent and reliable source of retirement income over the life of that obligation, however long it takes. And we also have a lot of very long-term loans and investments that we've pledged to people. Well, we're not going to call these unexpectedly on you. So we're thinking not just next quarter. We're thinking a year in advance, a decade in advance, and perhaps generations in advance on the products and services that we provide. So sustainability literally is core to our mission. And so when Peggy was out there talking to, and when all of us who engage with our investors, and we have a very broad definition of investors, it's not just people who provide financial capital, but when we were out there engaging with our investors, it became very clear to us that we needed to ensure that our commitment to long-term viability was represented by the skills and experiences on our board. Fortunately, we already had several individuals who had those skills and experiences on our board. And as both Heather and Candace have talked about, the board recruitment process is one that leads to that kind of rich discussion about skills and experiences and the breadth and depth of individuals' interests and what they bring to the board through their own background. So we've been able to reinforce that through other individuals that we brought onto the board, and adding to the depth that we already had there.
Great. And I can ask a version of the question that I asked Heather as well to you, Mary. Beyond the bringing on the person with the skill set, what are the ways to level up the entire board on these issues? So, for instance, our report talks about training, creating opportunities for boards to engage with stakeholders on these issues. What's Prudential done?
Well, we have a lot of different things that we do. We have the full, panoply of tricks up our sleeve, including engaging with various stakeholders at the senior executive level or with board members. We also have various ways for shareholders and others to communicate with the board that is not necessarily in person, but maybe through virtual means. We have periodic sessions where the board is given, or committees of the boards are given, business intelligence from management that they've gathered through engagements with our stakeholders or our shareholders, and that provides engagement around issues like board diversity or staff diversity, or you can think of any of the range of issues that might be material to Prudential's long-term sustainability. And then it's just how we as management advocate and present opportunities for change, not just as management of risk, but also opportunities to support the company's profitability going forward.
That's really helpful, Mary, and I think underlines again a key point which our report tried to underline, which is that this is not a one constituency game. This is a process of the board and management needing to work together to push the envelope on these issues on an ongoing basis. So let's move to our last topic, which is that of long-termism, and one that I think we can potentially talk about until 5 p.m. Only I know our panelists have to go in the next 20 minutes. So I did want to pull out at least, as many of you know, McKinsey's been spending a bunch of time working on this issue, and there were a couple of data points in a report that they released in 2014 that stood out to me. One is that 70 to 90% of a company's value related to cash flows is actually expected 3 to 5 years out. So value is actually created on a long-term basis. And the sort of the second and the juxtaposed point is that yet directors still spend the bulk of their time, 70% is not atypical, on issues of short-term focus, so things like audit reports, quarterly reports, budgets, and compliance. So in other words, in spite of the fact that, we've talked about long-termism and the role of boards as stewards of long-term value, through this conversation, there's still a clear dichotomy between, what we would like corporate boards to focus on and yet what they do end up focusing on for a variety of excellent reasons. In fact, both Heather and Mary made the point right at the beginning of the call that board member agendas are crowded. So how do we get over this? And Candice, again, let me begin with you. Crowded board member agendas, tough to add another issue to the list. Given the state of affairs, what do investors consider to be what the board can do in terms of advocating for long-term value creation as a part of their role?
Mm-hmm. Well, before we jump into some of those avenues, I do want to kind of speak to the shareholders' role in getting this issue on the agenda and come back to our role in the engagement process and really seeking clarity and transparency of the board's oversight function, right, through the proxy statement. So we can start with that one functional document. And we as shareholders have to be willing to come to the table and request that boards provide some level of a statement around their oversight of sustainability issues in their proxy or in their charters in some way. So seeking that acknowledgement is a step one for us from an investor perspective, because although it may seem a rather indirect route to getting it on the board agenda, once directors and their liaisons know that this is a type of disclosure, a type of transparency that a range of shareholders are seeking, then that'll push it onto the radar. Boards are going to want to be prepared to say, yes, we indeed do understand this issue that we are putting in our proxy. So that is one way in, and it's a starting point. But then in terms of some of the other ways, our perspective oftentimes is that the issue needs to be put on the agenda by the board itself. In the sense that we have to encourage directors, and again, this is about making sure that through engagement, directors understand we're looking to them to speak to this issue, and so that the board of directors, a director can actually go back to management and say, hey, we need to spend a little bit more time on this. Management often has a lot of control over the board agenda, and so part of the role of the director is to be independent from management's strategy, their agenda, their approach. So we want to know that boards are actually starting to help set this issue and bring it to the table. So again, we see it as a disclosure issue, really getting it on the agenda by making it a part of the charters for some committees, in particular when you're looking at a risk oversight function, say the audit committee, and seeing that transparency come out through a public statement to shareholders is where we see the proof in the pudding, at least, to start.
Great. No, thank you, Candice. So Heather, Candice talked about the role of the board. So what are your thoughts, again, sitting where you do? What is what can a board member do, sort of given what they do within an organization in terms of strategy and risk oversight, setting in place sort of the right executive teams, their role in terms of compensation? Are there opportunities to weave in a long-term thinking as a part of these functions?
Absolutely. And, again, I just want to underscore the importance of execution, obviously, on the board's behalf, but, the sort of push-pull between the board as well as the management and the need to work together to really, elevate this issue and get sustainability ingrained as part of the long-term thinking of the company. And to that end, I think the report really nailed this in a few key areas that are worth highlighting. The first being, advocating for a long-term planning horizon as part of overseeing the strategic planning process. The second would be, advocating for considering long-term risks, right? We've talked a lot about that today. And then And I think the third is establishing management compensation structures that are oriented towards long-term performance. So I think there are a lot of good recommendations in the report, but as you know, specifically thinking about your question about long-termism, and those are the three that really stuck out to me.
Great, and finally, let's move to Mary. Mary, we've heard a lot about how boards and management needs to work together. So, are there strategies that management can use to sort of orient the board towards sort of considering some of the long-term issues and like keeping the perspective about long-term value creation in mind as a part of their oversight responsibilities?
I think, Vina, that there are a number of very practical things that are not necessarily easy but have been proven effective. I think one is giving voice to external advocates and investors, whether they be investors or customers or just advocacy organizations, to the board and allowing them to hear what's taking place outside of the realm of what they would necessarily hear. Sometimes you can do this just by providing business intelligence. Sometimes you can do this by offering the board opportunities to go out and meet with these things. And so at Prudential, we'll bring members of our governance committee to various organizational meetings. I don't think we've brought anybody to Ceres yet, but we've brought them to ICGN and other organizations where they're going to hear about these different topics and actually have the opportunity to engage with people who are thinking about and interested in Prudential's approach to long-term value creation. I think one of the other things that we do is we build a nice groundswell of support by working with our internal partners. So as Candace said earlier, get something in the proxy statement. Well, we've been doing that for a very long time, and we built this nice partnership with Global Communications. So that has helped us actually integrate long-term value creation into Prudential's branding strategy. And that kind of communication reinforces the board's natural thinking in this area and also reinforces their ability to communicate Prudential's message and think about it in their own deliberations. And then finally, I think that speaking as a governance professional and working with a governance team, we need to think about setting the agenda so that effective governance is also helping the board find that right balance between today's profitability and tomorrow's long-term financial viability. And that is really, really hard to do because many of us in the governance areas don't really control those agendas, but we can, with our internal partners, suggest additions to the agendas that would then broaden the board's understanding and advocacy in this area.
Great. Thank you, Mary. I think so for me, the sort of takeaways from the panel discussion we've had so far is that this is difficult but doable. We need to be patient and the value of partnerships both internally and externally in terms of moving this agenda. So we've come to the open Q&A portion of our webinar. Unfortunately, we don't have as much time as I'd hoped, but we were having so much fun. I didn't want to cut it short. So what I'm going to do is we've had a number of questions flow in, so I'm just going to read off some of the questions and let's get to as many of them as we can. So we got a question about the structure of board sustainability oversight that makes the most sense. So from the perspective of the report, we're actually very deliberately agnostic on this topic. We don't believe that a board sustainability committee is necessarily better than the integration of sustainability into audit committees or into compensation committees or into governance and nominating committees. And in fact, in some surveys that have been done on how board sustainability oversight is being structured, what we see is a gamut of structures. But I'd love to pose this question to our panelists. Does any approach stand out for you as being better than the other? That is essentially having a dedicated sustainability committee versus integration into existing committees. Mary or Candace or Heather, any thoughts?
Well, this is Mary. I think from the perspective of the way we've structured sustainability at Prudential, I would argue for integration across all functions. The sustainability team at Prudential is very small because we work with some very extraordinary executives, both senior executives and then sort of entry-level executives in embedding sustainability within the business functions. I'm not going to be here I hope to hit the lottery soon. So, I'm not going to be here forever, I should say. And in order for sustainability to be sustainable, it needs to be owned throughout the organization. And that's why I think in order for sustainability to be truly sustainable at the governance level, it needs to be owned by all of the various committees and the big board itself.
Great, thank you, Mary. And I think that certainly reinforces the message of integration with which the report pushes out. Again, I'm gonna run through this because there are a number of questions that I want to try to get to before the 1 o'clock mark. So we got a question about resources for board training. So in 2006, Ceres had launched a process along with the Yale Business School and some other partners to really raise awareness among corporate directors on sustainability, particularly on climate change. And we did a few convenings. It wasn't really a formal training program. But I'd love to ask maybe our panelists about what you are seeing out there in terms of specific training resources for corporate boards on sustainability. So are there organizations that directors could go to? Are there certifications out there? What are you guys seeing? Heather, any thoughts?
Well, as a very new director, having been on the board of SNEER for only a year, I actually don't have a lot to offer in terms of specific resources for sustainability. And that's, I think, part of why I was so excited about the work that Ceres was doing. I think part of what we might want to think about collectively is, for the programs that are in existence that focus on helping, new directors understand their charter and mission, is doing some outreach to those entities and trying to see if we can layer sustainability into their curriculum as well.
Right. I think that's a great point. When we did our research as well, I think what we found was that, there are certainly some business schools that have courses on sustainability that they offer to executives, which, clearly directors could take advantage of. And we are seeing groups like the NACD or the National Association of Corporate Directors start to think about what sustainability could mean in terms of their focus areas. But this is clearly a resource. This is clearly an area where we believe a lot more work could be done. And certainly we will continue to think about this as well. The other organization that is doing interesting work in terms of board training, I should mention, is the UN Global Compact. That does offer sort of very detailed sort of engagements with the entire corporate board on sort of sustainability and materiality, which they have piloted out to a few European companies. I'm going to move on to the question of materiality. One of the questions that we've received is, given that so much of this conversation is about materiality, the questioner is looking for the panelists' perspectives on how companies, investors, and board members in fact decide what sustainability issues in fact rise to the level of materiality and what do not, and how that process works. So, Mary, would you like to take a crack at that?
Sure. Well, how do you define materiality? There's a whole bunch of different definitions out there depending on whether you're looking at the GRI or the International Integrated Reporting Initiative or just the SEC definition of materiality. And I think what we've chosen to do at Prudential is not to waver. We're going to stick with that SEC definition of materiality, which is, what is it that would cause a reasonable investor to make a decision to invest or disinvest from your company. What we did decide to do was to change our definition of investor to broaden it from people who are providing a variety of different kinds of capital, including financial capital. And I think that process of defining what are the material issues cannot be divorced from either the company's mission or from its day-to-day functioning. So the very nice framework provided by the International Integrating Reporting Coalition really, and looking at the different kinds of capitals that cause a company to be able to function anymore, is very helpful in making the decision about what may be material at a very high level that the board may consider, and then at a functional level where the sustainability folks and other business people operate.
Great. Candice, any thoughts on that? Hang on, we are unmuting you. Just give us a second, Candice.
Of investor, I think it's very
All
effective.
right, yes. Candice, sorry.
Oh, can you hear me?
Yeah, we can hear you now, so go ahead.
Oh, okay. Sorry. I just wanted to share that, I'm very impressed by Prudential's approach to this and really thinking through defining capital in different ways and thus defining investor in different ways. I think that's interesting and opens up a wide range of conversations with stakeholders. In terms of materiality, we've seen many different approaches from companies to get there, but oftentimes investors may come in on the back end. So we ourselves are looking at materiality issues in-house in terms of our analysts understanding how sustainability risks will impact the value creation model in a company so that we can understand and build that into our own models. And so we find sometimes, that we'll be able to specify certain risks that we find material and share that with companies. And companies also come to us to give feedback on their materiality sort of kind of discovery process and what they end up landing on. I think that dialogue is good, where companies are able to kind of go out to their shareholders and stakeholders and say, this is what we're thinking. Where does this fit with what you're thinking and what your priorities are? And usually it's a balance, right, between what stakeholders find to be very important versus what ultimately is also very important to the company's value creation model. And so we expect to see a materiality kind of summary from the investor side that really lays out that landscape and why the company chose the particular issues that it chose to focus on.
Great, thank you. We are on time, but there is one last extremely interesting question that I do want to ask, and then we'll wrap up. So this question is about the pace of uptake, right? How do you get more board members to take this stuff seriously? Our questioner, talks about the inklings for the potential for litigation regarding the fiduciary responsibility as it relates to climate change. So do you think this will help really scale up board member attention to issues like climate change, or is the progress that we're going to see going to continue to be instrumental? So I'm going to open this up to all our panelists. Anyone who wants to tackle that?
This is Heather. I guess I would say briefly that I think that there are a lot of different things that we are going to have to try. I mean, there is not one perfect answer that is going to make every single board, corporate board in America switch on a dime. And I think this is a trial and error period. We're going to I think everything from activist investors to lawsuits to potential SEC requirements on transparency. I think there are a lot of things that are going to help improve this process. But I would also say I don't think that there is one size fits all solution here.
And I think on that note, we should start to wrap. And I think the point that you made is a fair and valid one, Heather, as Mary pointed out. This is a process that requires patience, and clearly there are multiple levers that will continue to be needed to continue to raise the priority of these issues at the board level. So again, on that note, I would like to say thank you. So thank you to our amazing panelists for an extremely robust discussion and for their being extremely unfazed in tackling a number of what I thought were pretty difficult questions. So thanks to you. And thank you to our audience for your time and interest and all the great questions that came in. So more information about our work, including the report that we've been talking about, is available in the link that's included in the slide. And this is also where we will post a recording of our webinar. If you have any questions about the work that Ceres is doing on boards and sustainability, please feel free to reach out to me or my colleague Joseph Manning. And thank you very much for your time, and have a wonderful rest of the week.
Great. Thank you, Veena. Have a good afternoon.
You too.
Thanks.
Bye.